Hi everyone, and welcome back to the Independent Dollar. If you're joining us for the first time, we make informative and unbiased personal finance videos in a way that is straightforward and easy to understand. Today's video is all about asset allocation ETFs, a one-stop investment solution that allows you to focus on accumulating more income instead of having to manage your investment portfolio. Asset allocation ETFs are products that provide investors with a broad mix of assets in a single bundle, with the amount of investments and transactions within the portfolio kept to a minimum. Most providers will have various mixes for you to choose from, with asset mixes ranging from all equity to all fixed income and various stages in between. Some will focus on income-oriented solutions by prioritizing dividends, for example, while others will focus on trying to keep as diversified a mix of holdings as possible. The main draw for most investors is knowing that you don't have to constantly watch the amounts that you have in each sector, like your Canadian equity, US equity, bonds, or real estate, for example. Nor do you have to figure out how much to add or to remove from each holding as your portfolio changes in size. The product automatically rebalances itself in order to keep your long-term asset allocation in order. With all of the guesswork taken out, this sounds like the perfect product, but does it work for everyone? We'll take a deeper look into asset allocation ETFs, how they work, how much more you might potentially pay, and in some instances, where they may not be the right product for you. So how do asset allocation ETFs work? When we refer to asset allocation ETFs, we're referring to an ETF product that has a target or mandate in place to manage the amount of specific asset classes within the portfolio. If we look at most ETF providers, they will have a range of offerings in this space, but most will have a balanced option, and that's 60% in equities and 40% in bonds. They'll also have the inverse of that, in a conservative portfolio, which is typically 40% in equities and 60% in bonds, and those are intended for investors who have a lower risk tolerance. Other mixes are generally available to allow you to pick and choose which allocations best fits your personal risk profile. Since the ETFs automatically rebalance, it takes the guesswork as well as the emotion out of the asset allocation equation. By removing yourself from this decision and the work of having to monitor the allocations, you can have peace of mind knowing that your investments will continue to operate in line with your long-term goals and your risk tolerances. However, this benefit does not come without any monetary cost. As an investor, if you were to purchase all of the underlying holdings individually, the annual management fee would be less, and this will vary from product to product. However, you want to consider both the direct and indirect costs of these types of investments. The direct costs will be the ones that you incur by trading the ETFs back to the original weightings multiple times per year. The indirect costs are that of your time, as well as the gain and losses that you will incur from being out of balance. Depending on how long and how far you remain away from your targets, your holdings will deviate from your risk tolerance and your plans. On top of that, as you purchase or sell assets in your portfolio, you're going to need to decide the best method of doing so. There are other considerations when choosing an all-in-one product, and one that will be a major determinant is the range of the holdings. Typically, any manager that sells these products will almost exclusively use their own products to fill them. Depending on how large or robust their offerings are, you may only receive a segment of the market. For example, one vendor may have a single Canadian equity ETF to include, whereas others may have multiple ETFs and choose the one that is most appropriate. Similarly, the extent of their offerings may be limited on international and global offerings. What are some of the other reasons why people enjoy buying asset allocation ETFs? As markets move dramatically, like they have recently, there is a natural desire to want to protect your holdings and make changes to your allocations. As we showed you in our previous video about timing the markets, this can create unintended negative consequences, one of which being missing out on some of the best performing years. If you have a long-term goal in place and you've determined your proper risk profile, then no changes should be made. You would continue on as you would have had the markets moved just as significantly in the opposite direction. By removing the emotion from the asset allocation decisions, you will keep closer to your long-term plans. What would be an example of when these products may not be the right fit? A great example is when you're in the deaccumulation phase. As you enter this phase of your life when you're drawing down on your savings rather than adding to them, asset allocation products can present a challenge. both through investing and through taxes. When selling assets in an all-in-one product, you will be selling a bit of each of the underlying holdings. This may not be the most tax-efficient scenario for you, especially if you wanted to solely focus on reducing your equity exposure instead of lowering your fixed income as well, or vice versa. Another example is when you want to change your asset allocation very quickly, due to a change in risk tolerance, a life event, or as you get closer to retirement. This can be tricky for an asset allocation ETF. The simplest way to do this quickly is to redeem all of your units in one fell swoop and repurchase another product within your new allocation. If this is a taxable account, the implications on your tax return will be significant. If you wanted to move, for example, from an 80-20 portfolio to a 50-50, you could slowly do it over time by drawing down on your 80-20 portfolio and purchasing a 20-80 allocation in its place. You would also be adding any new money to the new 20-80 portfolio. Over time, this will then balance out to a 50-50 asset allocation. And finally, another scenario is when you already hold a significant amount of assets elsewhere. You may have followed our GIC laddering post and are using that strategy for your fixed income. Now in that case, you can't bring your GICs into the ETF itself. They must be held separately. This now means that you are then purchasing an all-equity portfolio, and the onus is again back on you to ensure the allocation between your GICs and your ETFs are at the proper levels. This wraps up our latest video on investing with ETFs. For more information, make sure you check out our website, theindependentdollar.com. As always, if you have any questions, feel free to comment below. Thank you so much for watching, and we'll see you back here next week.